Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is Rose Jenkins, a senior attorney advisor at the Tax Law Center at NYU Law. Before joining NYU, she was managing director in the International Tax Group at KPMG, and prior to that, worked in the Office of Associate Chief Counsel International at the IRS. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event is being recorded and will be posted online on TPC's website. We're using captioning, which you can adjust or turn off with the live transcript button at the bottom of the Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Rose Jenkins, welcome to The Prescription.
Thank you, Howard. I'm glad to be here.
Good to see you. We're at something of an inflection point in the taxation of multinational corporations. We're seeing major changes on two tracks. First, the OECD is leading an effort to create a consistent multinational, multilateral tax regime for these multinationals. At the same time, the Biden administration has proposed significant reforms to the US tax regime. Those reforms largely track the OECD's two pillars of tax administration, but there also are some intriguing differences. So let's start with the 2017 Tax Cuts and Jobs Act. It created an alphabet soup of tax changes, the BEAT, the GILTI, and the FIDI or the FIDI, whichever you want to say. Overall, could you describe briefly what these changes did?
Sure. So definitely the Tax Cuts and Jobs Act was definitely a sea change in international tax. And to understand how, I think it's helpful to step back a moment to what the international tax system was like before TCJA. So before TCJA, there were two main ways in which the foreign earnings of US companies, foreign subsidiaries, their controlled foreign corporations or CFCs was supposed to be taxed. The first way was under the Subpart F regime. And the Subpart F regime covered certain types of largely mobile and passive income, and tax those immediately at normal domestic corporate rates. And the Subpart F regime was meant to prevent profit shifting, moving income into low-income jurisdictions offshore. But it was enacted in 1962, and it wasn't wholly effective at its intended purpose. So the second way that foreign earnings were supposed to be taxed was upon repatriation, when CFCs distributed out the money to their US parents. And that also was supposed to be subject to tax at the normal US rate, which was 35% before TCJA. But in practice, a lot of foreign earnings were never repatriated in a taxable manner. So I think there are four big things that TCJA did in the international arena. As you mentioned, the acronyms there line up neatly with those. So the first thing that it was supposed to do was push us towards a territorial system where instead of companies being subject to tax on their entire worldwide income, they would mainly be subject to tax on their domestic income. And that was supposed to be achieved through a dividend received deduction that would apply when there were distributions from CFCs of their foreign source earnings. The next thing they did was the global intangible low taxed income regime, the GILTI regime that you mentioned. And that actually sort of pushed back towards a worldwide regime because it immediately taxed most of the income of CFCs, not just the narrow categories that were previously taxed under Subpart F. There were some carve-outs from GILTI for oil and gas income, and then also a percentage of CFC's investments abroad, tangible investments abroad, which was 10%. And GILTI was subject to a lower tax rate than the normal domestic rate. So TCJ put in a 21% normal domestic rate, and the intent was for GILTI to be taxed at half that, or 10.5%. So GILTI was supposed to disincentivize pushing profits offshore. And then on the flip side, FIDI, which is the foreign derived intangible income deduction, was supposed to incentivize bringing profits onshore. And it was supposed to do that by giving a preferential rate, which was 13.125% for a portion of domestic corporations' income based on their sales and services outside of the US. And then I think the last acronym that you threw out was the BEAT, which is the base erosion and anti-abuse tax. And that's supposed to address the stripping of the US base. So a basic base erosion play is for a company in a high tax jurisdiction like the US to make deductible payments to a related company in a low tax jurisdiction in order to move income out of the US. And the BEAT tried to address this by imposing a minimum tax of 10% on taxable income determined without regard to those base erosion payments.
So this was all enacted 5 years ago, the end of 2017. What happened? How have US-based multinationals responded to all these changes?
Well, so it's been a big transition effort. There's been a lot of work that's gone into it, and it's continuing to go on. And there have been some surprises in the transition process. One thing that's near and dear to my heart is, one of the smaller changes that TCJA made was to try to address a problem with foreign parented US companies trying to get out of GILTI and Subpart F by melting down their ownership in their foreign subsidiaries. And TCJA made a change to the attribution rules that was billed as a really narrow change, just addressing the sort of meltdown planning. But it actually turned out to be a much broader change that caused a lot of surprises to a lot of taxpayers who hadn't been paying attention, and some complications that continue to this day. So you'll see Build Back Better actually proposes to just undo the TCJA change and put in a more targeted change. Another interesting thing that we've seen is that there has been a lot of uptake on the FDII deduction. There was a report earlier this month from Marty Sullivan about some of the year-over-year changes on FDII benefits, and we've seen, for example, a 300% increase to $5 billion for the top 5 tech companies. We don't really know what that's attributable to. It might be Marty Sullivan says that it might be because FDII is easier to claim under the final regulations than it would have been under the proposed regulations. It could also be that companies were rushing to take advantage of it in case it went away under new legislation.
So one of the goals of this back in 2017 was to encourage firms to do more economic activity in the US rather than internationally. Has that happened? And I know COVID sort of confounds anybody's analysis, but what is your sense of it? Has some offshore activity moved back onshore as a result of all of these changes?
Yeah, I don't know if we know. I mean, the FDII benefits might suggest that there has been some onshoring, because you might see increase in FDII benefits because of onshoring of intellectual property. There were some issues with the BEAT that did cause some companies to look at bringing back some of their intellectual property as well in order to avoid the BEAT. So it's possible that it has caused some activity to come back on shore, but it's not really clear.
Okay. So that's where we are in the United States. Before we talk about Build Back Better, let's talk about the other big news, which is what's going on at the OECD. So after years of kind of stalemate, in part because the United States wasn't willing to kind of play ball with any of this, the OECD earlier this year agreed to its Pillar 1 and Pillar 2 reforms. They've been endorsed, at least in concept, by about 140 nations. Briefly, could you just describe what each of these pillars attempts to accomplish?
Sure. Yeah. So Pillar 1 is meant to create a new taxing rate for jurisdictions based on the markets that they provide for multinationals. And Pillar 2 is supposed to provide a global minimum tax that will apply to multinationals' income in order to reduce tax competition.
Okay, so conceptual agreement is one thing, but each member nation now has to pass laws to make these ideas a reality. Let's leave aside the US for a moment, because we're going to talk about that in some detail. Do you think that OECD member nations, in fact, are ready to adopt these reforms?
Well, so I mean, earlier this week, we saw that the OECD released model language for the Pillar 2 legislation. And the EU had already messaged that once that language was released, they'd start working on a directive to implement it. And I think there's been talk since that was released that would happen. So there's definitely been discussion of how implementation would go forward. And there are some consultations planned for next year as well on working through the implementation process. So I think everyone is engaging constructively.
So you mentioned the EU, and I'm reading this week that, of course, it needs unanimous approval of its member nations to adopt the minimum tax. And I read this week about Estonia, And now suddenly everybody's worried about, will Estonia agree to this? Is that kind of an indication of the problem here, that you have countries in very different economic situations, very different relationships with US-based multinationals or other multinationals? Getting them all to agree on this plan seems like it's a real challenge.
I do think that has been part of the struggle in the past couple of years as we've worked through this. And even after the OECD made the announcement in October, you saw a lot of NGOs and representatives of lower tax countries saying, we're not really on board with this plan. This isn't really giving us all the benefits we thought we were working towards. So yeah, there are a lot of competing interests here.
Do you think they'll get resolved in the, let's say, the next year or so?
Well, so I mean, I think one thing that's critical to note is that it doesn't, the OECD proposal doesn't necessarily require everyone to sign on. There are layers and layers of rules and backstopping rules that are meant to ensure that if not everyone signs on, someone else will make sure that the right amount of tax is imposed. And that's supposed to encourage people to join on, because they don't want to have someone else, have another country take what they could take if they went ahead and implemented these rules. So I think that will hopefully be encouraging, but we'll definitely have to wait and see.
So just as you noted, just in the past few days, we've seen a set of new OECD rules for what it calls the Global Anti-Base Erosion Model, or GLOBE, another acronym. It'll become the backbone of Pillar 2. And it says, it's interesting, it says consideration will be given to how the US GILTI provisions will coexist with Pillar 2. So explain to us how the current GILTI does conform with those rules and where the conflicts are.
Sure. I mean, so GILTI, by its name, is supposed to impose a global minimum tax. So in broad strokes, it does do that. But it's currently at a 10.5% rate, and the OECD proposal is for 15% rate. So the current GILTI doesn't get to the right rate. One big difference that is, part of what's at issue with the question of whether GILTI will count, is that the Pillar 2 rule looks at financial statement income, which makes sense. So if you've got a bunch of countries that you need to be sorting out, you don't want to look at each country's own definition of income. Whereas GILTI would still stick with the US definition of income for CFCs. And so those are some key points. There's also a substance-based carve-out in the OECD provision. We have a similar rule, but it doesn't quite match up. The OECD rule looks at both tangible assets and payroll. Our rule that I mentioned just looks at tangible assets. Right now it's 10%. Theirs starts out at 10% or 8%, gradually works down to 5%. And then the other big thing, and this is where we'll get into Build Back Better, is that the Pillar 2 rule is a country by country computation. So you do look to see whether tax is subject to an appropriate rate on a country by country basis. Whereas our GILTI regime currently, you just throw all the foreign earnings together in one big pot.
Okay, so that brings us to Build Back Better. Why don't you again just give us a brief description of how the House version of the bill, of course we don't know what's going to happen to it, but how the House version of the bill changes that TCJA's framework. You mentioned obviously country by country is one place, but give us a sense of some of the highlights of the changes in Build Back Better.
Sure. So I mean, on the GILTI front, and really I think overall country by country probably is one of the biggest changes. Right now, because you have GILTI computed in one big pot, if you have a US company with one CFC that is subject to a 25% tax rate in country A, and another CFC that's subject to a 0% tax rate in country B, you can use your foreign tax credits from your country A income to offset your US tax on your country B income. The country by country computation that's in both the House and the Senate versions of Build Back Better would not allow that to happen. You would no longer be able to use your country A foreign tax credits against your country B income. You also wouldn't be able to use your country B losses against your country A income. And that is consistent with the Pillar 2 proposal. The other big change that's made on the GILTI front is it does raise the rate to about 15%. So that's consistent with what we see in Pillar 2. That's sort of offset by a change in what's called the GILTI haircut. So right now, companies can only claim 80% of their foreign tax credits that relate to GILTI, but that would go up to 95% under the Build Back Better bill. And then also there are changes to what goes into the GILTI income base. So they're getting rid of they would get rid of the oil and gas exclusion, which is in line with the broader climate change goals of the bill. And they would also reduce that reduction that I mentioned that's based on tangible assets abroad from 10% to 5%, although they wouldn't get rid of it the way that the Biden administration had proposed.
So my TPC colleague Thornton Matheson did the math, and she calculates with all of these changes, the effective GILTI rate would increase from just over 13% to nearly 16%. Does that sound right to you?
That does sound right. Yeah, that does sound right.
Okay, so then much closer to the minimum tax that's contemplated in Pillar 2.
Right, and also much closer to the overall normal domestic U.S. rate, which has been a key point.
Right, correct. So anytime I see these changes, I think that there are going to be winners and losers among US-based multinationals. In a broad sense, can you give us an idea of what kinds of companies will do well in this new regime and which will do less well? Maybe by industry? Is there any way to kind of anticipate that?
I'm not sure that I could give a breakdown by industry. I mean, I think that the change by country will affect companies that sort of had a mix of high tax CFCs and low tax CFCs, where they were counting on that ability to blend, and they won't be able to do that anymore. So that's one profile that's definitely going to be affected more than say U.S. companies that had sort of medium tax CFCs.
Mm-hmm. Are there any other kinds of companies we could think about? Any other ways to think about this in terms of how it affects U.S. multinationals?
Well, I mean, I think some of the changes to the BEAT also will definitely affect the U.S. multinationals, and so we could turn to that. I'm not sure that I have a lot more thoughts on the GILTI front.
Okay, so let's talk about the BEAT then. There are also some changes there in Build Back Better. How do those work?
That's right. So, I mean, since TCJ, there have been criticisms about the BEAT being both over-inclusive and under-inclusive. It was under-inclusive because it applied to a narrow set of base erosion payments, and there were sort of generous thresholds for U.S. income and base erosion that needed to kick in before it had even been applied. But it was also over-inclusive because it applied to payments that were already subject to U.S. tax under Subpart F or GILTI. So the administration had proposed just sort of scrapping the BEAT and replacing it with the SHIELD, which stands for Stopping Harmful Inversions and Low Tax Developments. I'm always nervous I'm not going to get through that.
Who thinks of these acronyms? That's what I want to know.
I don't know. It's got to be a full-time job for someone. So the SHIELD would have disallowed deductions equal to intragroup payments if there was a low tax member in the group. And Build Back Better, the drafts that we've seen so far, do not adopt the SHIELD. They just go ahead and make changes to the BEAT. But those changes do move it in the direction of the SHIELD and the OECD agreement. And one of the big changes is actually expanding the range of base erosion and payments it applies to. So it now can cover payments to foreign related parties for inventory and other amounts that go into cost of goods sold and are capitalized. So now it does have a broader application.
And as we know, it also gradually raises the rate, I guess, to about 18%. So
that's right, yeah.
So you mentioned the SHIELD that didn't make it. That would have been a pretty significant change. What do you think happened there? Any insights into why that didn't make it?
Well, it is a significant change. I mean, it would have been very difficult to draft, first of all, and then also to administer. So that may have been part of the reason why they thought, just making tweaks to BEAT was more straightforward. The other thing is that it was supposed to be consistent with the OECD agreement, with the undertax payment rule within the OECD agreement. And what the undertax payment rule is trying to do is get you to that agreed upon 15% global minimum tax rate. But what the SHIELD would have done was just disallow all deductions to the extent it applied, which really would have gotten you to a 21% tax because those deductions are being offset against U.S. income subject to a 21% tax rate. So there may have been concern that we didn't need to go so much further than the Pillar 2 agreement would have done, and that we should stick closer to that 15% agreed rate. I mean, that 18% is halfway between the 15 and the 21, and we're not getting there for a long time, as you mentioned.
Yeah, it's like 4 or 5 year phase in, I think, isn't it? Yeah.
Right.
Yeah. So explain to me how this happens in the United States. Do we have to approve a tax treaty? Does the Senate have to pass a tax treaty in order for us to adopt the OECD framework?
So the idea is that Pillar 2, we could mainly sign on to just through our legislative changes that are being discussed in connection with Build Back Better. The changes to GILTI and BEAT would hopefully move us close enough to what's outlined in the OECD model that we would be there. Although, as you mentioned, the OECD has said they're going to reserve until next year whether GILTI will actually count. Pillar 1 is definitely a different story. Pillar 1, so right now the OECD is working on drafting a multilateral convention that countries are expected to sign on to that would implement it. So ideally the US would sign on to that, or they would rework their treaties in line with that. There are concerns about that process, given our track record the past decade with Senate ratification of treaties, and the current political climate. So there have been other options that have been discussed, sort of an agreement that's passed through more normal legislative procedures, or maybe even an executive level agreement, like the ones that the US has entered into under the Foreign Account Tax Compliance Act. So I think it remains to be seen how exactly the US will sign on to Pillar 1, and that's something that has to be worked on.
Do you think an executive level agreement would hold up?
Well, it seems to have held up under FATCA.
Yeah.
So.
Yeah. Okay. So let's talk a little bit. We focus mostly on Pillar 2, but let's talk a little bit about Pillar 1. Obviously, it's a little more kind of less immediate, but still, I think, a really important issue. And it acknowledges the greater use of a destination-based tax by member countries. It focuses on one version of that, which is digital services tax. And it seems aimed at heading off kind of these unilateral efforts by many countries to impose their own DSTs, mostly on large US-based tech companies. Is it going to achieve its goal, do you think? It's temporary, at least tentatively or temporarily headed off these individual nation taxes. Is it going to continue to do that, do you think? Will it succeed?
Well, I think if it's signed on to, countries have agreed, the US has reached some agreements with countries to put their DSTs into abeyance, pending what happens with Pillar 1. There is also, the administration has also been working on foreign tax credit regulations that would address some sort of jurisdiction-based taxes, like the DSTs, but not just the DSTs, other taxes that they call extraterritorial. So those were proposed late last year. They're supposedly going to be finalized any day now. So if they are finalized in close to the form that they were proposed, they would disallow foreign tax credits for a lot of the sorts of taxes that we're talking about here. So that could also have an impact on everything that happens here.
So let me ask you just very broadly, beyond the specifics of what the OECD is proposing and what we're talking about here, given the way technology is changing, given the way of economics and finance changes, do you think we are inevitably heading towards a regime of destination-based taxes? Is that where we're going, where the world is going ultimately?
I think that might be a little over my pay grade. It's definitely something that gets discussed a lot. I think we'll have to wait and see.
Yeah.
We are also seeing it, even on the state level within the US, which has been an interesting process to compare and contrast with the global stage. So it's definitely not going away, but it's also being contested by taxpayers, and obviously the US is trying to deal with it through the OECD process, and we'll just have to see how things shake out.
Yeah, it's interesting. I live in Maryland, which is trying to tax digital advertising, so I know all about it.
Yeah.
It's interesting. So the US in 2017, we talked about everything it did do. One thing it didn't do was adopt a destination-based tax. There was a debate about it. It was briefly in legislation, but it was dropped. And it's interesting. There's a little bit of a conflict, right? So many of the provisions of Build Back Better are intended to sustain the existing worldwide system, and they conflict a little bit with the Pillar One like destination tax. How do you think we're going to kind of resolve this? And it's sort of a short-term issue, but then there's a longer-term issue.
Yeah, I mean, short term, I think the U.S. is pretty committed to the existing regime that we have and trying to shore it up. I think you can see that even in the Senate version of Build Back Better, where they went even further than the House bill and put in some provisions relating to inversions, which had been left out. So I think that the goal right now, short term, has been to preserve the status quo and try to make it work as well as possible. Longer term, I mean, obviously, jurisdictions are pushing for more of a destination-based type tax system, and so we'll have to see where that goes.
Mhm. Let me ask you about the regulatory environment. So there have been recent news reports about the Treasury struggling to keep up with issuing guidance about corporate community regulatory needs. You were involved in some of that work, I assume, when you were at IRS. What have been some of the major sticking points that still need to be addressed?
Well, so I mean, the Tax Cuts and Jobs Act was a huge bill and it had some flaws. So the government had its work cut out for it, and they did try to address a lot of the major guidance areas right away as soon as possible, and they also focused on anti-abuse rules in sort of the first round of guidance, and there were multiple rounds of guidance in most areas, and so they had to work through multiple rounds of guidance. There were a lot of comments they had to work through, a lot of thinking about considerations like what leeway they had for certain rules, and so not everything has gotten done. There are still some proposed regulations that haven't been finalized, like the foreign tax credit regs that I mentioned, and also some rules that had been proposed relating to making the old Subpart F regime more like the new GILTI regime. And then there's some rules where they just haven't even really gotten started. So they did anti-abuse rules on that dividend received deduction that I mentioned, but they haven't done any general rules. And apparently those general rules are on hold pending the changes to the dividend received deduction under Build Back Better. And then the other big area that companies have been clamoring for guidance is related to previously taxed earnings and profits. So PTEP rules are meant to ensure that when a US company pays media tax on its CFC's earnings, those CFC's earnings aren't subject to a second layer, a duplicative layer of tax when they come back to the US. And the mandatory repatriation tax that TCJA put in made companies pay tax on all of their subsidiaries' foreign earnings going back to 1986. And then going forward, we also have CFC's income mostly being subject to GILTI. So we have a lot of PTEP in the system now, which exacerbated some of the pre-existing issues with those rules. Plus, now that there are all sorts of different kinds of PTEP with different rules that apply to the different kinds, there are a lot more tracking and coordination issues. So people have been really desperate for that guidance, and we still haven't seen that.
So many of the Trump era rules, I think it's fair to say, were favorable to corporations. Do you think the Biden Treasury is going to roll any of those rules back, or do you think there's going to be a change in the kind of the general outlook on the regulations to accompany the law?
I wouldn't want to speculate on what rules they might roll back. I mean, I think Treasury was probably trying to get at the best implementation of the rules they could, given what they had, but also minimizing loopholes. And I think they'll continue to try to do that if we see changes in Build Back Better. So I wouldn't necessarily expect a shift in the type of thinking, but obviously there will be a lot more stringent rules as a result of legislation that will then flow through the regulations.
Yeah, I mean, I guess what has to happen is a lot of the regulations they were working on under TCJA will now be irrelevant because of the changes in Build Back Better, assuming Build Back Better passes.
Some of them, yeah.
Yeah, interesting. Well, we are out of time. Rose Jenkins, thank you so much for joining us. It's been a pleasure to talk to you and to learn more about international tax.
Thank you for having me.
And I'd like to wish you and all of our audience a happy holiday and a wonderful new year. And let's hope Build Back Better in some fashion actually passes, so we have more to talk about early next year.
Hopefully.
Thank you so much.